guys, good morning. Today I have a special guest with me today. I have Krysten Gallo. She's an accountant here with KWG Tax Services. She's here to help clarify some things that we've been told with this new tax reform, and I want to make sure that everyone here understands how this is going to affect your family and your financial planning with residential home buying and selling in the next couple of years. So thank you, Krysten, for giving us your time this morning. I know you're busy. You've received a lot of phone calls over this, I'm sure,
Yes.
here recently. So let's go ahead and get started.
Okay.
First of all, the biggest thing that they've really told us is the new mortgage interest deduction has been taken from $1 million down to $750,000. Will that affect current mortgages?
It could, yes. Mainly probably for majority of people that have second homes, I would say, or might be potentially entering the second home market, just because the limit prior was $1 million and now it's $750,000. So here in California, our home prices tend to be higher, so we require larger loans. With that, we may not enter the second home market as much because we won't get the deduction.
Okay, that's a great point. So if you currently own a home and you close before December 14th, you still qualify under that $1 million
Correct.
tax exemption. But going forward, if you wanted to buy a house, and we're now in 2018, you buy a second home this year, you're now looking at what your total...
Yes, so prior it was at two mortgage interest deductions, two mortgages that you could take combined to have the $1 million deduction. Now that $1 million deduction is just decreased to $750,000.
Okay.
You can still have up to two mortgage interest deductions combined. Yeah,
That's great. So then what price range would you say is likely to have the biggest impact? As I understood, it was that $900,000 to $1.25 million. 1.25, assuming a 20% deduction or down payment,
Yeah.
Thank you, wouldn't have qualified anyway for the $1 million.
So basically, a home that costs $937,500, assuming they put a 20% down payment down, would have a loan of $750,000. So anything above that would not receive the full benefit of the mortgage interest deduction. Anything below that would.
Okay. So what would you say if someone came to you and said, I really love this house, but 20% down, I'm over $750,000. What would that mean to them if they bought the house?
Well, if they only have a certain amount to put down and their loan is going to be over the $750,000, they have to essentially calculate what does that mean in terms of tax savings or additional taxes that they're going to owe because they're not going to get that deduction. So I did do a couple calculations, and I wrote them down, so I'm just going to refer to them. If there's a home that costs $950,000, for example, that's over the figure that we provided earlier, $937,500. With a couple assumptions, 5% interest rate, also a married filing joint couple in the 24% tax bracket, and they put 20% down. With that, they are going to put a down payment of about $190,000, and that would leave a loan of $760,000, which is $10,000 over the $750,000 cap.
Yes.
That would equal approximately annually $120 additional tax. So when you look at it that way, $10,000 doesn't seem to break the bank. But if you look at a home that's $1.25 million, which was on the upper range that you suggested earlier, that would equal approximately $3,000 in additional taxes owed because you're not getting that deduction.
Annually.
Correct. Annually. So that equals approximately $250 per month.
Yeah.
Yeah.
So although it's been lowered down to $750,000, I think it's important to understand that these are small increments. In no way will this slow down the residential home buying market here in Southern California, especially in that price range. Yeah. And so to move on, I wanted to bring up the biggest changes here, which is SALT. Krysten, could you explain what SALT stands for and what that means?
Sure, it's state and local taxes. So that is your state taxes and your sales tax, your local taxes. So that's also included in that little section on your Schedule A is your property taxes, and those are taxes you pay to your county. So there is a cap on this section of $10,000 now for taxpayers that itemize. If you don't itemize, you're not affected.
Right.
But if you do, this is where you're having that $10,000 cap.
And most people don't itemize, as I understand it.
Well, actually, it depends.
Okay.
So in California, I would say that because our tax rate is so high, one of the highest states, a lot of people would itemize just solely based on their state taxes. Now with that cap of $10,000, they're not going to itemize because they can't take that deduction.
Right.
So they will be taking the standard deduction, and the standard deduction has pretty much doubled. So.
And so some people see this as a double tax, as they pay taxes and now they're getting capped at a rate of $10,000. Would you agree with their?
I can see where they're coming from with that statement. Essentially speaking, we make a certain level of income, and we're taxed by the federal government on that income, and then we're taxed on the state government as well on that income. So before, we were given a deduction for some of the taxes that we would pay to the state from the federal side. So now that we're capped at that, I can see why someone might say, oh, it's almost like I'm being double taxed. But in reality, it's just kind of increasing our effective tax rate, because we're going to owe that tax to each governmental agency anyway. And property taxes, thankfully, in the state of California, with Prop 13, are incrementally increased.
Right.
So, thankfully.
And so with everything going on with SALT, are there any tax benefits that have offset itemizing?
Yeah, so the standard deduction doubling, that's a huge one. So with that, I will say that you're going to want to talk to your tax practitioner, your accountant, because there is a lot of tax planning associated around that. So for example, there might be some taxpayers that might want to itemize every other year based on their activity. Maybe they have specific charitable contributions, they want to double up in 1 year and then not do something the next year and take the standard, and then the following year double up. So they're maximizing their deductions. It depends on each individual taxpayer, so you're going to want to consult with your practitioner. The other part that the tax reform has implemented is Section 199A, and this is primarily for it's a deduction, 20% deduction, primarily for pass-through income for small businesses. So that would include, partnerships, S corporations, your sole proprietors, even your rental real estate on your Schedule E. So all of these are considered businesses, and all of that income comes into play for that deduction.
And I think Krysten hit a huge point there. Make sure you see your accountant. Make sure you go and you get advice best suited for your family and your financial planning. Make sure they know what they're talking about, and if you need someone's information, I can make sure to pass you on to Krysten. It's a big change that's happening, but it's all manageable, and it's luckily, unfortunately, it's not going to destroy the residential market here in Orange County. Always going to buy and sell homes, so if you have any questions, we're here to help. And thanks again, Krysten, for your time.
And if you have any questions, you can find me at KWG Tax Services.com.
Wonderful. Thanks so much. Have a wonderful day.